In the previous chapter, we looked at the two concepts, and I would argue twin concepts of expected gains as well as law of large numbers. The example that we used was a little bit simplistic because it was throw of a dice, and for throw of a dice it is trivial to compute and associate probabilities with each possible outcome. It's not so simple for a trading strategy, and when you cannot compute an outcome in a mathematical sense, you basically fall back on experience. So the way to assess the impact and the quality of an investment strategy is that you design a system or an algorithm or an idea factory or whatever you want to call it, run and at least simulate that particular strategy over a long period of time, and then depending upon whatever parameters which are the variable cogs in that strategy, compute experientially the probability of each outcome. And once you have assigned that, then you can get to the expected gain per trade that you're going to get in future. And of course you have to continue to improve and continue to assess that strategy all the time. So based on all the previous data, and this is the snapshot for Swing Plus, and I think it is sometime in April 2018. I remember that number because this is about 1202 trades is associated with that time frame. So, and this is for a setting, as you said, as we discussed last time. This is in the last chapter. This is dependent on two key settings. What's your target profit? In this case it is 100%. And what's your target stop loss, which in this case was 5%. So the probability of 100% gains out of these 1202 trades was 44%. Probability of going into a stop loss, which means losing 95% of your money, was 28%. Okay, so these two numbers alone don't add up to 100%. So what happened to rest of the trades? Well, both wins and losses. So if you just look at this here, actually win ratio was 51%. It is computed right there on the web page. So probability of number of wins was 51%, number of losses was 49%. Now when you put all of this together, you still get an expected gain of $209 per trade for these settings. What does this mean? This means that for 1202 trades, on an average, you make about $200 a trade. So your total gains over these 1202 trades is 1200 multiplied by 209. And of course, there are some assumptions here. So for example, a key assumption is that you are at least, this maths is actually done exactly on $1,000 investment made per trade, but you can scale that down if you're making just $500 or $400 or $600 or whatever that number is for every trade. This will change, but in terms of a percentage, it will remain the same data, but on Milestone Plus now. Okay, and here you can see one key difference. There were the number of trades itself in this strategy go down. It's exactly for the same time frame. The average US dollar per profit per trade goes up a little, win ratio goes up a little. Okay, and this number is again created for the same settings, which is let's look at this: 100% target gain and 5% stop loss. So the expected gain per trade goes up. Now let's look at it live in the website itself. So this data, again, this snapshot is 581 trades. So this is slightly newer than what we were looking at in the previous part of the video. And let's see, let's ensure that we get the same settings. So target profit per trade 100%, and target stop loss per trade is already at 5%. Let's go back to milestone plus. Okay, let's see what happens. So win ratio is still about 56%. You are getting $262 on an average per trade, and 286 out of the 581 total trades made at least 100%. There is some more data here which is graphically represented. So the first graph is talking about wins versus losses in recent 581 trades, and you see right here there are 323 trades which were wins, and number of losses is about 258. So that totally adds up to 581. Similarly, I think this data is more interesting. So profits, and I'm looking at the second graph, this one. So profits and losses in dollars for recent 581 trades. So whatever trades you won on, the strategy made $368,000 of winnings, and whatever trades it lost on, it lost $216,000 of losses. So net you made 368k minus 216k, which is roughly 150,000 or 60,000, whatever that number is, probably 150k, and you divide 150,000 with 581 here, and you get 262. So the maths is quite straightforward. Again, keep in mind that this analysis is assuming $1,000 investment per trade, so you have to tune your expectations depending upon how much investment you are going to commit to a strategy and how much investment you are going to commit to every trade. Now there is another graph right under it which is quite interesting to look at, and that is profits made over time. So you can see, let's see, so this starts, it's better to zoom in. So this starts in January 2017. So that's the date when you're starting. That's when you made your first trade. That's how the web page is built, and so your profits are zero at the start, and as you go forward your profits start to creep up and creep up and creep up. So that's how this is built, as you go forward in time, you can look at both the y-axis and the x-axis. So this axis right here is money and this axis is time, and right now we are looking at May 2018, and this is where if you just draw a line, you will see it's roughly ending up at about $150,000. So over last one and a half years, for these settings, if you had followed every single trade, which is this long list, which is this list of 581 trades, starting on January 10th all the way to right here on April 30th. There is nothing on after April 30th. Then this would have led to this kind of investment performance here, which is what you get based on the theory of probability and expected gains and whatnot. And the same data is available for the other algorithm as well, which is a little bit more aggressive in making the trades. You can see the number of trades are roughly double, and then milestone plus strategy, where it was 581. So that goes double, but the average US dollar profit per trade goes up as well, which means that, you know, goes down a little bit, but then you make much more money, because even though this is just 171, you are making many more trades. So the effective amount of money that you make goes up drastically compared to the other strategy. If you look here, it's 697,000. Let me use the right oval here. So it was 692,000 for wins. You lost 488,000 on losses, all the losses, and effectively that turned out to be, and on May 3rd, let's go down. So right now we are looking at this point, May 3rd, and the amount of money that you have made till now is, actually it's right here, it's about 200k. The graph tells you, but look at this graph a little bit more closely, especially this part, and see what happens. It has gone down drastically in last few months. So in January 2018, which is roughly this point, this was nearly 300,000, gone down to 209,000. So clearly this strategy is more volatile than the previous strategy. But net, if you stick to the probabilities and stick to all the numbers and all the ideas that you see down here, and we will invest a lot of time on this in subsequent chapters on how to make use of precisely these informations and what these means, then this is how your portfolio would have fared.